Hey everybody, Matt Graham, MBS Live here with you on Wednesday, April 1st, 2020. Bonds are stronger now. They weren't stronger this morning, and I'll talk all about that in a second. So much going on. Where do we even start right now? Send me questions if you got them. We'll start live streaming here too. I got that set up. We're ready to go. It's going to be amazing. You're going to love it. I'm going to love it, but we'll have to wait. Let's move on. The one thing that's super duper interesting to me today is this 5-day UMBS chart, 2.5s. Can't really emphasize how crazy it is to have gotten over 105 in prices after breaking 104, which was like this mystical level that we thought we wouldn't see after we broke 103. So then 105 came in pretty short order and things were just nuts. It wasn't really good for margin calls. Obviously, that's a big story for some of you, and nothing that you really need to understand for others among you, but it caused some issues. Actually, you do need to understand it because it's central to what I'm about to explain. The margin call thing it's a thing that secondary has to deal with, and it costs them cash today that they would likely or will likely get back, all other things being equal. But the cash today can be pretty huge depending on how markets are moving. It has to do with how they protect you and your locks to ensure that they can fund those deals and also protect themselves from interest rate movements that occur between locking and funding. It's basically taking a short position today and then buying it back when you close, and that whatever gain or loss happens in that trade is offset by whatever they sell the loan for on that day. And if things are pretty stable, they never really hear much about it in between the locking and the funding. But if things go crazy, now the money that they could owe when the loans fund can get huge. And if it's too big, then the companies they are dealing with can do a margin call and request that they send some cash to tighten the ledger back up. And that was, according to some, threatening to put small independent mortgage banks either out of business or in a real pickle when it comes to staying solvent, paying people in an already stressful economic time, etc. So the industry was clamoring for the Fed some were clamoring for the Fed to stop buying MBS, which was relatively insane because you can see what's happened over the past few days with the Fed simply buying, only $20 billion a day of MBS as opposed to 36. And anyway, they wanted the Fed to buy less. And I think the Fed needed to buy less. I think 105 was absolutely ridiculous. And I think the Fed wasn't paying any attention to the prices it was creating in the MBS market. And I think it started to pay attention on Monday morning. And you can see, as if by some miraculous magic, if you look at the calendar of buying, which started at 10:30 a.m. on Monday morning, that's exactly when prices started to drop. And then looking down the calendar today, 2:20 p.m. is exactly when we bottomed out in price. And these shifts in prices tend to coincide with the Fed's buying windows. But all that having been said, forget all that. Even if we don't know that, look at how volatile the chart was over a 1-month time frame. And then click to a 5-day, and it's like this perfect little asymptotic deceleration, decline in prices, gently coasting, drifting, wafting down to a 103 to 104 range, which is exactly what I said would happen on Monday morning. I said the Fed just needs to realize what they're doing, and they need to peg bonds in a 103 to 104 range, and that would give us the stability we need to tighten up margins to whatever extent they can be tightened up. It would provide some relief for margin calls, and the world would be a better place. And so that's exactly what happened, and I'm shocked that it happened so well, because throughout this time, if we change this chart to tens, you can see the movements in 10-year yields look quite a bit different. Not only that, but over the course of 5 days, it's a linear move in treasuries towards stronger levels. Over the course of 5 days in MBS, it's not a linear move. It's up and then down. And it just has unseen hand written all over it. And even if that's not the case, even if somebody way smarter than me were to tell me, oh no, the Fed isn't like targeting prices to make them go down, I wouldn't believe them. It's too good to be true, or too conclusive to be true. Whether or not it's good, it's up to you. But I definitely think 103 to 104 range in UMBS 2.5s is a much better place to be than 104 plus. But hopefully we can hang out in this range or something close to it and then move on. Moving on today, ADP employment, swing and a miss. Why wasn't it a bigger loss if we had 3 million jobless claims, etc.? So was that the second time I said etc.? Hope not. It's an overused word sometimes. Anyway, it wasn't bigger because they stopped collecting data by March 12th, something like that. Yeah, March 12th. And that's not when things got really nasty yet. So the next report will be really nasty. And it's going to be the same for NFP. NFP won't be as big as it should be. Right now, the forecast is calling for non-farm payrolls to drop 100,000. That's definitely in the realm that's suggested by ADP right now. Doesn't really matter though, because next month will be millions. I don't know how many. I don't know how quickly it's going to respond to jobless claims, but the chart that I posted in the day ahead this morning showed that they did line up pretty well back in the Great Recession with NFP down 800K and jobless claims up around 700K. So it wouldn't be a surprise to see it pretty close to the jobless claims number. Not a market mover because of that, because we know the worst is yet to come in terms of data. Let's talk about more important things. Why does your pricing suck? Well, we talk about this a lot, but your pricing sucks in part because of all that Fed margin call stuff causing panic and distortions in the primary mortgage market, making business tough for your lenders, making them really want to increase their margins for extra operating cash. And they're also increasing their margins because of this massive tidal wave of uncertainty surrounding the forbearance issue. People are talking about forbearance and deferrals as if it is a unidimensional issue for servicers. Here's what I mean by that. Servicers we think of as the people that collect the money. And then the other aspect of that, the other side of that, is they got to take the mortgage payments they receive and pass them through the agencies to the bondholders. And the bondholders, aka investors, are counting on getting paid in a certain way. For Ginnie, it is getting paid principal, interest, taxes, and insurance on time every month. For Fannie, it can vary. There are a bunch of Fannie loans where the principal portion is not required. It's only required if you collect it from the borrower. And then there are some loans where it's called actual, meaning you only have to pass through the actual principal and interest that you receive from the borrower. But Ginnie is all scheduled, meaning whatever the scheduled principal was and whatever the scheduled interest was, you got to pass that through to investors. Otherwise, they're going to get cranky. And if they get cranky, then FHA is going to have to back them up, or Ginnie Mae is going to have to back them up. And if everybody were to run out of money, they'd have to take a draw from Congress, and it would be a big, nasty thing that would cause a systemic collapse in the mortgage market. Yada, yada, yada. It's not going to happen. Treasury would just bail them out, and then we'd go about our business. I shouldn't say it's not going to happen. It's highly unlikely. And it's very likely that Treasury and the Fed, or some combination thereof, would act preemptively to stem that tide. And they have already put out an announcement about that for the Ginnie Mae side. No such announcement yet for Fannie and Freddie, but it's expected, may be part of different facility called the TALF, and it may be something completely new. Either way, my point about it is that people are talking about this servicing issue as if it is the big risk, the big thing that needs to be addressed for the housing and mortgage market. It's the big thing, right? But it's not the biggest thing in and of itself. It's part of a bigger deal, which is this forbearance tidal wave, and that is a problem regardless of servicers being able to pay bondholders, because it's just so massive. We have people out there among you guys telling me a certain percentage of your borrowers is contacting you to find out about forbearance, and more than 50% of them are gainfully employed and haven't lost their jobs or haven't lost income. And that's a big problem. If that many people are going to take advantage of forbearance, it is a massive, massive upset, shock to the system. And it completely rewrites the rules of risk and of prepayment speeds and servicing valuations for everybody in the secondary mortgage market. And it makes it so nobody really knows what servicing should be valued at. And if people don't know what servicing should be valued at, then they can't price loans effectively. And all of that uncertainty is being pulled out of the loan pricing that you normally see at most lenders. It's being pulled out of the loan pricing you normally see, doubly so, triply so, quadruply so for Ginnie loans. So if you're wondering why your FHA or VA sucks, that's why. And lenders are furthermore applying overlays to stuff that's in a certain credit profile that is more likely to cause servicing issues. There are several different reasons they could be doing that, and I don't know which one is their favorite or which one they're leaning on, but to make it really simple, just think about it in terms of the 2008 financial crisis. The loans that lenders pull back on first are the riskiest ones. And the loans that are getting hit hardest right now in pricing, it's the exact same story. So whether, mortgage investors think that these FHA deals are super risky because they're going to have higher servicing costs, or whether they think, higher servicing costs because of the way that they're repaid, or higher servicing costs because of all the headaches that the loans might cause if a massive amount of them move into forbearance. The bottom line is you don't really want to have to figure that out one way or the other. You just don't want to buy loans that run the risk of causing headaches for whatever reason when you don't know how those headaches are going to be cured. So that is why lenders are pulling back from anything that has a more subprime type credit profile. And you had the director of FHFA on TV today saying blatantly in black and white that subprime, the new subprime is and has been FHA. We know that's not entirely the case. There are definitely borrowers with great credit that do FHA loans for whatever reason. But, he has a point in that those credit profiles tend to be more subprime-like in many cases than your conventional borrower. At least that's how investors are pricing it, and that's why your pricing sucks. But you want to know why your conventional pricing sucks compared to other conventional pricing you may have heard about. And this is a more confusing and also a very valid question. And it's definitely something that's going on. Otherwise, I wouldn't have been saying the discrepancies between lenders are as high as we've ever seen them for, I don't know, at least a month now. But there's a good reason for that too. And it has to do with the exact same issue we just talked about, which is the value that investors are placing on servicing. So if your lender, for whatever reason, and there can be a couple, is going to have their compensation adjusted based on the value of servicing, and everybody does to some extent, but if you're going to have to let somebody else take the servicing from you and they don't want to pay very much for it at all, maybe they even want you to pay them to take it off their hands to give them that headache, your pricing is going to suck. If you can sell direct to an agency or directly through an agency and you can keep your own servicing or farm it out for cheap, then your pricing you can afford to have much better pricing because you're taking the risk on those servicing headaches. You are stepping up and saying, I accept whatever the consequences are of this uncertainty in servicing. And in those cases, your pricing is MBS minus some pretty nominal stuff and minus a pretty nominal charge of actual servicing. But then you are going to get hit over time, depending on what happens in your servicing portfolio. So you are getting better pricing today in exchange for uncertainty in the future that may affect your pricing in the future or may affect your company's bottom line in the future, depending on how you do business. Other companies are saying, I'm just going to take the pricing I can get for the security side of it, and then I'm going to take the hit to get this servicing out of my site and let somebody else deal with it. And so that quote unquote somebody else dealing with it premium right now is massive. Companies don't want those loans. So they're making you work for a lot cheaper in order to stick them with that bill, as it were. Does that make sense? I hope it does. If it doesn't, use the contact us link in the help menu. I'll keep trying to explain it a different way every day if it takes that. But yeah, it's a critical thing to understand for pricing discrepancies. Will it change? Yes, it will. How long will that take? I don't know. It's going to take weeks, if not months. This is a really complicated issue, and we really need to see how the forbearance tsunami is going to play out because it could go so many ways. And the frustrating thing and the thing that's really important to remember in all that is the way it plays out is going to depend on how coronavirus plays out. So if things are worse than we're currently anticipating, and everybody's talking about the 140 to 200K projection for deaths. Sure, let's say that's it, but let's use that as a baseline. Now, say we have, 600,000 deaths over 2 years and the vaccine doesn't perfectly cure this, or people can get reinfected. Oh no. And this thing is like a part of our society forever where a certain percentage of us are afraid to go out and do anything. It has massive consequences for joblessness in the future, and it's going to materially damage home prices and lending liquidity, and it's going to be a big nasty thing that nobody really is going to like very much at all. Now, let's say it only kills 100,000 people. That's a terrible thing to consider in and of itself, but relative to other options, it's small. Let's say that happens. Let's say the vaccine is highly effective, and let's say infection rates are similar to the flu. Now, all of a sudden, experts can say this is like having another flu out there, but if you're really old and catch it, you're more likely to die, but that's really the only downside. Then I think the world gets back to work much more quickly and much more resoundingly, and all of this stuff clears up much quicker. Now, we're not going going to know necessarily how the vaccine is going to play out in a couple of weeks, obviously, but we will know more about how infection rates and death rates and hospital crowding and all of the apocalyptic panic scenarios are either healing or accelerating, or at the very least being fought and managed. When that stuff starts to get more clear, then the forbearance picture will start to get more clear. But we need to see how many people are out of work and stay out of work. And when that happens, factor in whatever temporary programs we have out there to help the people and see how things are responding. It could be something that is that adds up to a time in your life that you look back on and say, that was truly the most awful thing any of us ever lived through from an economic standpoint. We could be entering an economic time frame like that. And it might not be because of the direct damage that comes about by this joblessness. It might be some unintended consequence that results from the way we manage it. We don't really know. It's all an experiment at this point. Is it okay that the Fed is buying trillions of dollars of bonds? They think so, and a lot of smart people do, but we'll see. I don't have a strong opinion one way or the other. All we know right now is that there's a way to justify it, and it's not as scary as your average Facebook commentator would have you believe, but a lot of things aren't if you're getting your news from those sources. All we know is the Fed definitely has absolute control of where it wants bond prices to go. We know the Fed has said what it's buying right now is a pittance compared to what it would be willing to buy and what it could easily justify buying. And just hush your little mind and don't you worry about how much they could buy, because it's more than you could possibly imagine. And yeah, those weren't Powell's exact words, but it was his exact message. And he didn't hesitate in saying that on several occasions. And so that's the Fed's stance. And they keep doing stuff to help promote liquidity and to help monetize this massive sovereign debt that we're going to have. And one of the latest instances of that was this rule change this afternoon. If you were curious about that, and you don't really need to be, but it just means that banks that are holding a lot of treasuries don't have to count those treasuries in their leverage ratio. So they can lend more of the money they do have without having to keep a certain amount of cash money on the books to satisfy this leverage ratio requirement. They can send more of that cash out the door in terms of lending and rest easy that their massive treasury holdings can be quickly converted into cash at the Fed's standing repo facility, which is a new thing. And so it's really a move that makes sense. It allows big banks to lend more and to not have to hold as much of their own cash on their books. And it also allows them to buy more treasury, which we really want them to do, because who the hell else is going to buy them? I mean, I don't know. 1.246% 30-year bond might look like a good rate of return in a year. You might wish you had bought that at that time. I think the issuance will probably keep yields, from going too much lower. You never know, though. It's a big moving target. But I guess what I'm saying is, in this brave new world, which could see depressed growth for a long time, current treasury yields might not look like a really bad place to park your money for a risk-free long-term return. And I think that is probably as much of a commentary as I could ever give on where the economy might go. I hope it doesn't go there, but it's a possibility that's being considered. Should you lock or float? I don't know. What kind of rates do you have access to? You with one of those lenders that isn't taking a big bath on servicing, then lock and be happy. If you're able to lock a deal that's on that fringe of a subprime type credit scenario, definitely lock it and try to get some, small peace of mind, some assurance that you're going to be able to fund it, because be very aware deals are getting pulled. It's not pervasive yet, but it is a thing. Locked, docked, ready to sign deals are getting pulled, and people are being told, nope, can't fund it. And that's something that is happening, will continue to happen, and may happen in greater numbers in the coming days. On the other side of the coin, deals that you were worried about getting funded have funded. And that probably has to do with the changeover from March to April, which I don't know why they put 93 days in March this year, but it felt like quite a lot. And I hope that we don't have to do another 93-day month ever. That's a joke, by the way. There was not really 93 days in March. It just felt like it. I know you knew that, most of you, but some of you didn't. So that's who I was explaining it for. All right, the video's getting long. I'll let you go. And just do hit that contact us link if you have a question, or if you got my email, mgraham@mbslive.net. Shoot me an email directly and I will answer your question in the next video. And I'm sorry if I said I was going to answer one of your questions and didn't get to it, but I think I did. That's going to do it for today. Back with you guys tomorrow. Have a great rest of your day.